The interest paid over the life of a standard 30-year mortgage often approaches or exceeds the original purchase price of the home itself. Most homeowners understand that interest is part of financing, but relatively few have ever calculated their own specific total before the loan is nearly finished. 4 different extra payment scenarios will be examined in this analysis, and the results at each level change the total financing cost more dramatically than most people would initially expect. The parameters in this analysis reflect a realistic current market scenario. The loan is $320,000, which reflects a standard financed amount for a home purchase in many major markets today. That amount represents the balance after a 20% down payment on the property. The purchase price of that property is $400,000. The interest rate is 7% annually, which sits near recent national averages for a fixed-rate mortgage. The term is 30 years, the most common amortization period for primary residence mortgages in the United States. At those inputs, the required monthly payment comes to $2,129. That figure stays constant for the life of the loan unless the borrower refinances or pays it off early. Each payment divides into 2 components. One portion covers the interest charge for that month. The remainder reduces the outstanding principal balance. In the very first payment, roughly $1,867 goes to interest. The remaining $262 reduces the balance. The interest portion dominates early because the outstanding balance is at its peak. The bank is collecting its percentage on the full original principal. As the balance falls, the monthly interest charge falls with it, and a greater share of each payment starts going toward the loan itself. But the balance falls slowly. After a full year of payments, the balance is still over $315,000. 5 years in, the outstanding balance has barely moved. It remains near $300,000. The loan appears to barely change in the early period because the bulk of each payment is consumed by the interest charge on a large balance. By the end of the loan, the borrower has paid back the original $320,000 in principal. They have also paid the lender $446,000 in interest alone. Total dollars transferred to close the loan exceeds $766,000. The home was listed at $400,000. That gap between the purchase price and the total cost of financing is the number this analysis is designed to reduce. The first scenario is the smallest adjustment, $100 per month above the required payment. That amount is less than $4 per day. For most households, it disappears into routine spending without leaving a financial trace within a week. Directed at the mortgage balance instead, the effect compounds quietly for years. The mechanism is straightforward. Each extra $100 reduces the principal more than the standard payment would on its own. A lower principal means less interest accrues the following month. Less interest means more of every future payment goes toward the balance. The cycle builds on itself with each payment made. With $100 added to every payment, the loan closes ahead of the standard schedule. The payoff arrives roughly 4 years early. Total interest paid over the life of the loan falls to approximately $376,000. Savings compared to the default path, about $70,000. 4 years of payments eliminated. $70,000 retained by the borrower rather than transferred to the lender. The monthly cost to produce that result is $100. Doubling the extra contribution to $200 per month produces a result that exceeds what most people would project from a simple doubling. The payoff timeline shortens by roughly 7 years. Total interest paid falls to approximately $328,000. Savings, about $119,000. The savings grow more than proportionally because of how compounding works. Both $100 increments operate on a balance that is already declining faster than the standard schedule. Each payment reduces the principal by more, which reduces the following month's interest charge, which then allows the next payment to reduce the principal even further. The effect is non-linear. Adding $200 per month changes the payoff timeline meaningfully. The mortgage closes in roughly 23 years. 7 years of payments eliminated. $119,000 in interest that never accrues. For a household that redirects that $200 from a recurring expense, the financial position shifts in a way that compounds over time. Stepping up to $500 per month extra pushes the analysis into more striking territory. The loan closes in approximately 18 years. Total interest paid falls to about $240,000. The savings compared to the default path, roughly $206,000. That figure has a useful reference point. The original loan was $320,000. The interest saved at this payment level represents nearly 2/3 of what was originally borrowed. The borrower does not refinance. They do not negotiate a new rate. They redirect $500 per month that they already controlled. In return, they keep $206,000 that would otherwise have gone to the lender. The 18-year payoff also matters structurally. The first half of a 30-year mortgage is where interest charges are most concentrated. Closing before the original midpoint means leaving before the most expensive interest accumulation period ends. The compounding of the reduced balance has the most ground to cover in those early years, and $500 per month lets it run that course faster. At $1,000 per month above the minimum, the loan closes significantly earlier than the standard schedule. The payoff arrives in approximately 13 years. Savings compared to the standard path, just under $280,000. Place that number alongside the original loan amount. The principal was $320,000. The interest saved by paying $1,000 extra per month is nearly equal to what was originally borrowed. The borrower keeps almost as much as they took from the lender in the first place, simply by consistently directing funds they control toward the balance. A borrower who takes this mortgage at 30 reaches payoff before entering their 50s. The monthly payment that consumed a fixed share of income disappears 17 years ahead of the original schedule. The cash previously locked into that payment becomes available for other purposes far sooner than the standard path would allow. The $1,000 scenario is not feasible for every household. The underlying principle is scale independent. Any consistent extra payment begins the same compounding process adjusted to the available amount. Dollar amount matters. There is a second variable that changes the outcome just as dramatically, and it is the one most households defer without calculating the cost of deferring. That variable is when the extra payments begin. Extra payments made early in the loan have significantly more impact than the same payments made later. The reason is structural. At the start of the mortgage, the outstanding balance is at its maximum. Every dollar of that balance generates interest each month. Reducing the balance earlier eliminates interest charges on a larger principal for a longer period going forward. Starting extra payments of $500 immediately saves substantially over the life of the mortgage. The interest reduction amounts to roughly $206,000. Starting that same payment 15 years in changes the outcome entirely. The savings drop to approximately $47,000. The payments are identical. The timing changes the result by roughly $159,000. The reason is visible in the numbers. By the midpoint of the original term, the outstanding balance has fallen to approximately $236,000. The remaining interest exposure is lower. There is less balance left for the extra payment to work against. The early extra payments were protecting against interest charges on a much larger balance for each of those intervening years. The same principle explains why waiting for a salary increase, a bonus, or a refinancing event to begin extra payments carries a calculable cost. Every month of delay in the early years is a month where the balance is near its highest and the interest clock is running at full speed. The most powerful extra payment is the next available payment, not a larger deferred contribution planned for a future date. The numbers in this analysis do not point toward a single decision. Mortgage debt at 7% carries a different priority than high-rate consumer credit. Every household has its own liquidity needs, investment goals, and financial constraints. Some borrowers will find that directing extra capital toward investments with higher expected long-term returns makes more mathematical sense than accelerating mortgage payoff. What the analysis establishes is that the default path has a specific and calculable cost. Most homeowners have never seen their actual total interest figure. Most have never modeled what $100 extra per month would produce across the remaining life of their loan. A basic amortization calculator produces that number in a few minutes. Knowing the actual cost of the default path versus an adjusted one is the foundation of a financial decision rather than an inherited financial habit. That is the difference between accepting the bank's timeline and choosing your own. Sources for all data in this analysis are listed in the description below. If this breakdown was useful, subscribing to this channel brings more financial analysis each week.